First order of business, if you were allied with Italy last night, I stay true to my promises. There's a box of biscotti, cookies, and prosciutto in the CTF village. This is not a joke. Ask Austria-Hungary here. He knows. For those of you doing contests, most of them end at 4. If you're doing HeboCon, that starts at 2 right after this talk. That'll be out in the pool area. I think that's all the announcements I have. So without further ado, this is Dr. Tran doing insurance for your cyber breach. Take it away.
Thank you. Hello. Great. For those who are curious about the scotch that I handed out, it's a Balvenie Caribbean cask. So it is actually scotch that has been matured in rum casks instead of bourbon and sherry casks. So for those who sat in the first 2 rows, you got a little bit of taste of that. Great, so insurance for your cyber breach. The reason why I wanted to do this talk was really to shed some light on this growing trend of insurance companies offering insurance in the event that you get breached. It's a little bit different from traditional insurance products that you may be familiar with. First, a disclaimer. The views expressed are those of mine, not my employer or any professional associates. So my company doesn't really know I'm doing this, so let's try to keep it that way. Thanks. So what we'll go over in the presentation, who I am, overview of insurance, what the current offerings are for cyber insurance, what the current market is, what to beware of, and also some advice on whether to help decide whether cyber insurance is right for your company. So who am I? Professionally, I'm in the information security team for a financial services and insurance company. So I actually work with the business folks that create the cyber insurance products. So even though I'm not necessarily an insurance background person, I do have IT and security background. So that's where we help them understand the security problem. Personally, I'm originally from Philadelphia. Anyone else from Philadelphia? No one? All right. I guess I'm a loner up here. I'm also a member of Tool, so if you've been to the Lockpick Village, I help do a lot of these Lockpick villages around the country. And that's kind of the stuff I do for fun on the side. So, what is insurance? In a nutshell, insurance is the act of transferring risk or distributing risk across either a group or to a company or to another entity. The earliest form of insurance, documented form of insurance, was in 3000 BC in China. And what they did was, it was very common for people to transport goods through river rapids on boats. However, with the choppy water and the dangers of river rapids, sometimes those boats might get destroyed, along with the cargo that is on that boat. So if a merchant were to send his goods down with his boat across the river or down the river, there's a risk that he may lose his entire shipment. So what merchants started to do was to actually distribute their goods across each other's boats. So if there was ever one boat that was destroyed or lost, they would only lose a portion of their goods. Everyone would share in that loss, but it would not be detrimental. So that was the earliest form of recorded insurance-like activities. Now, what people generally think of insurance now, or insurance to each and one of you, insurance is basically a promise to pay when something bad happens. You pay a premium, some amount of money to a company. There's a contract in place with a policy where the promise is you're paying a certain amount of money if you were to suffer a loss that they are promising to pay. So it's an interesting industry because you're not paying for any physical product. You're basically paying for a promise. And then a claim is basically just a request for a payout in the event of a loss. Of course, there are processes to prevent any fraud when there's claims. So, let's say you bought insurance, all of a sudden you decide to smash your car into a wall and try on purpose to get the money. There are things that insurance companies try to do to minimize fraud, any type of fraud from insurance. But now I'm going to go into a little bit the details of how insurance works on the back end, what an insurance company actually does to write that policy for you. So insurance is based off of actuarial data. And you can think of this as a big database. It's a lot of data, historical data, as well as any type of projections they may have for things like auto insurance, life insurance, insurance companies have really, really good actuarials. All you have to do is answer maybe 5 questions, and they will be able to guess when you will die with pretty accurate, with statistically accurate estimation. So it's kind of scary, and that's how they're able to price the products. So using that actuarial data, there's a process called underwriting. You can think of underwriting as pricing a certain risk. If they want to offer a product based on that data, how much is that risk worth? So they take that data and then they create a policy out of that, the terms, the conditions, how much it costs. Then there's the premiums. The premiums, the money that you pay for that transaction, and then the claims. So you can think of premiums as money going into the insurance company and claims as money going out of an insurance company. Now, it's about to get a little bit businessy, but there is a KPI, or key performance indicators, for all insurance companies called the combined ratio. And that's basically the claims divided by the premium. So the idea is if the score is over 100, the company is paying out more claims than it is receiving premiums. Does that make sense? They're paying more money than they're receiving. So that's a KPI that insurance companies have. Most insurance companies actually pay out more claims than they receive in premium. You're probably thinking, how is this sustainable? How are they able to make money? They actually don't make money off of your premium. The point of insurance is not to make money off of that. Because they're pricing the risk and know with a certain degree of, based on their actuarial data, they know how long it will take before a loss may occur. They're holding on to that money that entire time. And what do you do when you don't have money just sitting around? You invest it. So insurance companies don't make money off of premiums. They make money off of investments because they know how long it takes for, let's say, if you were to buy a auto policy for like a Honda Civic, they will say, well, statistically, based on our models, you're not going to have an accident for 6 months. They can invest that money for 6 months and make a return on that. And it's okay if they lose a little bit more money from claims than they receive in premiums. That's perfectly okay. And then, of course, that claims data goes back into that actual data for them to further refine and make their models more accurate. The secret sauce to insurance companies is the actual data and underwriting. There's a lot of common kind of rule of thumbs that people may be familiar with, such as young males between the age of 16 and 24, they're invincible, right? Or, married people are boring, so they're less likely to do risky activity. Those are kind of things that most insurance companies know. But there are other things that insurance companies may be able to dig into that actuarial data and figure out. Some examples I have, DUI insurance. If someone has had a DUI before, some insurance companies won't even insure them. And if they do, the prices are going to be astronomical. However, Progressive was able to figure something out. They realized that the people who have had one DUI, they're the safest drivers out there because they will never do it again. So they can charge an astronomical amount of money, but protect themselves because they know that this driver is going to be well behaved. Now, if they get a second DUI, that's when they'll say, hey, we're not going to insure you anymore. But they knew, looking at the data, that people with one DUI was going to be one of the safest drivers on the road, and they could make tons of money off of that. Another example that I think some people may be aware of, asbestos mining. Insurance companies actually knew that asbestos was dangerous before there was any scientific proof, because they started to notice that anyone working in an asbestos mine was dying younger. So they were able to see that in the data. Some recent things that insurance companies have figured out, some of this is really obvious, but they're able to verify it with data now. The cost of hail damage for certain zip codes were different. Even though it's within the same state, it varied. So what they did was they overlaid public meteorological data over their claims data, and they were able to figure out that based on where you are in meteorological patterns, that the hail size varied. And hail size over a certain size caused massive damage, while hail size under a certain size did not cause damage. So they're able to price hail protection much more accurately and also provide corporate customers. So if a car dealership buys insurance, they may be able to advise and say, hey, you're in a high-risk zip code. You may want to put a roof over your car lot. And then a recent one with piece of data that insurance companies, or some insurance companies have figured out of Hurricane Sandy on the East Coast, was storm damage was not dependent on the size of the building. It didn't matter how big the building was. It was correlated to the frontage of the building, or how much surface area was exposed on the street. Because in New York, all the buildings are right up to next to each other. So only the surface area that was exposed to the street got damaged. So insurance companies previously were pricing that risk based on the size of the building, how much square feet. They were doing it wrong the whole time. So these little tricks that, or things that companies can look into the actual data, they can create more accurate pricing, better risk advice to the customers, and also protect themselves to make some money off of it. And of course, I said, the success is minimizing exposure to the risk, paying out claims, and also the maximizing profit, or the amount of time they have the money to invest. So with cyber insurance, so with some of the other insurances that you're somewhat familiar with, a lot of the policies and terms are very similar. You buy an auto policy from one company to another. The terms are very similar. What you can and can't do, terminology is very similar. With cyber insurance, coverage is going to depend on what company you go with. Every company is going to offer different types of coverage. Here are some examples of some of the things they may cover. Cost of regulatory proceedings, if you have to hire lawyers to defend yourself against a regulator trying to sink your business. Any disaster recovery costs associated, any incident or forensic response costs. If you bring in a mandiant or someone, the policy will pay for that, depending on your policy. Credit monitoring for customers if you have some type of customer data breach. And even extortion, some companies offer. If some Russian hacker blackmails you, the company may pay for that extortion fee so they don't DDoS your site or something. What's not covered? Of course, negligence, any non-compliance to agreed upon terms, controls, or regulatory requirements, and of course, any illegal activity. And every insurance company, the terms and exclusions will be different. So it's not like your auto policy where you go from one company to another. It's familiar territory. Every company is going to offer something different, so that's a little scary. Some of the key drivers, of course, for the demand for this type of policy, a lot of large breaches are more public now, so a lot of risk management teams, the board, finance teams, they're kind of worried about this. They're worried about their company being on the front page of the Wall Street Journal. Governments and regulators are being more strict about breach notifications and other types of notification requirements. And also, there's some contractual obligations. Depending on what industry you're in, specifically if you're working on, if you are a subcontractor for a defense contractor and you do business with that defense contractor, they will generally require you to have cyber breach insurance. Kind of check the box, say, hey, you have this coverage, or they will not buy parts from you. So there are some industries where it's required. Here's just some data metrics showing the number of reported breaches, average cost of a breach, and also just how often people are Googling cyber insurance versus cyber security. You can see there's a major increase over the last few years. So currently, globally, another metric, another business term, gross written premium is the amount of policy or premium that's being collected by an insurance company, or in this case, in general, across the world. Currently, there's $2 billion being paid in cyber insurance premiums, as compared to 2013, which was only $1 billion. So it is almost doubling year after year. To Lloyd's of London, which is one of the first modern insurance companies. Does anyone know when Lloyd's was founded, or kind of the event that caused Lloyd's to be founded? Anyone? The Great Fire of London that burned down, I think, half the city or so. That's when this company was formed to start offering fire insurance for buildings. Sorry? I think maybe 200-300 years ago, I say. Maybe I'm wrong, but it was during the Great Fire of London. 16? Okay, 1600s. They're estimating that that cyber insurance is potentially an $85 billion market globally. To put that in perspective, the entire U.S. auto policy market is $48 billion. So all of the money that everyone in the US is paying for auto insurance adds up to $48 billion. And Lloyd's is estimating that cyber insurance globally is $85 billion. So that's a massive amount of money. And PwC recently did a study and an analysis and noted that cyber insurance is the fastest growing specialty line of insurance ever in history. No other insurance product has grown at the rate that cyber insurance has been growing. So the way that cyber insurance is underwritten, it's very, very rudimentary. You basically get an application you fill out. Here are some sample questions. Are you PCI compliant? If you process credit cards. Do you have antivirus? What kind of data do you store? Do you analyze network traffic? These are literally questions from an application. And then kind of based on those responses, if you don't answer anything incredibly awful, you may be an eligible customer. They may decide to do a further analysis, but not always. They may ask for a pen test result. Hey, what's your most recent pen test? We'd like to review that. They may want to review what your disaster recovery plan is, but not always. And that's the extent of what they do to understand how bad or how good your company is with security. And then, of course, the results out of all of that, they may form the policy terms. You must do X, Y, and Z for us to cover you, or, yeah, we'll cover you, but only for X, Y, and Z, and only under these certain conditions. So, again, the policies can vary greatly from company to company and even situation to situation. So some of you may be thinking, yeah, that sounds very crude. How can you understand whether a security program is good or not based on, do you have antivirus? Do you analyze network traffic? I mean, those are very binary yes and no questions that don't provide a lot of insight. There's really no insurance company has a really good model on quantifying the cost of security risks. Insurance companies are actually working with tech companies to do that. AIG, for example, is actually working with Mandiant to try to figure this out. There's very little actuarial data available. There's some public data such as the Verizon, I think, annual report, Symantec releases a report. But that data is not in a very uniform format. And it doesn't really go into the level of detail that you may need to quantify a risk. Because it's not granular enough always. The questionnaires also only provide insight into how a security program is designed, not necessarily how it's actually being run. A pen test may give you a little bit of insight into that, but how exhaustive can a pen test be? If you think about it, we do car crash analysis on cars, medical studies on illnesses, and we do environmental surveys for natural disasters, but we don't really do that type of analysis for breaches. And if we do, every company that does an analysis does it in a different way. It's not uniform, so you're comparing apples and oranges. And as I mentioned, pen tests are only a point in time. So should you buy cyber insurance if you actually have a say in what your company does in this space? You really need to understand what's being covered based on the company you're talking with. And also, your company needs to really think about, is it really required? What are you trying to do? Are you just trying to check a box so you can do business with someone? Are you actually trying to transfer risks? Or are you really trying to protect yourself? You need to know what you're trying to protect, and you don't want to just go into this blindly. Really understand what those exclusions and conditions are. If you were to get breached, what are the things that you may have to pay for? What are the, do you have to pay for customer credit monitoring, lawyer fees? What is it you're trying to get paid for? Also understand, is there a risk that based on the application responses that you provide, there's a gap? Recently, I think in the last 2 weeks, there was an insurance company that actually sued their customer because in their application, they said, yes, we do this. But in the process of the insurance company paying for the forensic and post-breach incident response, they realized, oh shit, they weren't doing any of this. Breach of contract. They sued the customer and got them all of the money back. So you have to be very careful with those exclusion clauses because they can really screw you over. And of course, this is a decision that the risk management team in your company is going to have to decide. Is the cost, is the cost of the premium worth it? Is it really going to protect you from being on the front page of the Wall Street Journal? Is it really going to help your business from sinking if it gets public that you were breached? So that's up to the risk management team to decide that. And also, when you're working with an insurance company, it's always good to have someone from the security team involved in those discussions, because generally they will be meeting with the risk management team and the finance team, not the security team. Get a feel if the insurance company even knows what they're talking about in terms of security. I mean, when we helped our business team revamp their application, we just looked at the application and said, what the hell were they thinking? This just makes us look like complete idiots. So we actually helped them reformulate the application where we asked more intelligent questions, which I'll go into a little bit about on how to improve cyber insurance. So the future, of course, the objectives of the insurance companies is for more accurate pricing, not only so they can price their policies more cheaply to sell more, but to also protect themselves from having to pay out claims. They want to really be able to add value to their customers, depending on their business model. They want more actuarial data, because there really isn't anything out there in a uniform manner. Governments and regulators also have a stake in this. Because governments and regulators feel like they want insurance companies to help refine what the best practices in security are. And they figured, hey, historically, insurance companies have helped make cars safer, have helped people make healthier decisions because they know what's good and what's healthy and what's not healthy. So their mindset is maybe insurance companies can help improve security through market forces. So some thoughts that I have on how to improve cyber insurance is to improve how we look at or identify risks, better able to quantify it. Instead of questions like, do you have antivirus? We should instead ask questions like, what is your incident response process? How long does it take for you to identify something, respond, and remediate? Because that's a lot more important whether you have X, Y, and Z product in place. It's more important how you react to a situation or a scenario. That's more important. Better collection of breach information. Because there's no consistent way of collecting this data right now, it's useful to understand what controls in an environment are failing that allow a bad guy to get in. Be able to record that based on maybe who the bad guys were, what industry you're working in. Maybe with insurance companies may be able to see patterns such as, we see the cybercrime ring in Russia specifically targeting, let's say, retailers, and they use these types of attacks. I mean, that's information that is useful to help customers potentially protect themselves and also protect the insurance companies so they don't have to pay a claim. And maybe even improving the monitoring of risks in an environment, similar to how there's telematics now with some auto insurers, where you put some OBD2 device to kind of monitor your driving behaviors. There are even some thoughts on partnering with some tech companies or products where we help them keep an eye on things. We can kind of raise our hands and say, hey, we noticed that this kind of weird stuff is happening. Not so much as a monitoring service, because that gets into a whole gray legal space that we don't want to get into, but trying to figure out that balance of partnering with tech companies and businesses to be able to help better monitor the risks that are going on out there. So those are kind of some of my thoughts on how to improve cyber insurance. But in summary, cyber insurance is very immature, but the demand is continuing to grow. As I said, the potential market is, according to Lloyd's, is $85 billion, but there's only $2 billion being paid in premiums. So there's a lot of opportunity for companies to jump in and start offering these services. But the growth is slowed down because no one really knows how to crack this nut yet and do it right. Insurance companies will need to build better actuarial data, whether that's through information sharing, through government entities or industries. Some industries are sharing information with one another, but it's very siloed. It's very industry specific. There needs to be some way of bringing that data together, or maybe some company building their own proprietary database that becomes a de facto standard that everyone uses. And also, finally, the products that each company will offer will vary greatly, so buyer beware. Really know what you're getting yourselves into and understand what those exclusions are. So that's kind of it. So that's my contact information. I guess there are some questions out there as well.
Yeah, there was a law passed, I think it was December of last year, that was supposed to facilitate data sharing. Has that had any impact on what you said about needing to share data to build the network?
Yeah, I believe that was a required, data sharing for anyone who does business with the government. So yeah, that can be a basis for a framework on how the industry can adopt that. Maybe they're not required to adopt it, but they can adopt it, but that is a framework. However, I think the idea of information sharing is sexy, but a lot of companies are also reluctant to share that information because they don't want to provide too much detail on, how was I breached, what controls failed in my environment. So there's also reluctance in companies doing that type of sharing. From my understanding, the organizations that do very good sharing, it's very siloed to a specific industry. But also the data that they're currently sharing is not actionable. They're going to provide very high level information. Hey, look out for Russian crime ring with this IP range that we have seen. That's a good start, but that may not be enough data to kind of facilitate herd immunity.
Doesn't tell you anything about the defensive posture.
Yeah, exactly. Yeah, it doesn't tell you what failed at someone's environment to allow them in. Any other questions? Yeah.
Unlike car insurance, you said all policies are different than this. Is that purely because this is new?
Yes, this is new, so no one really knows what best way of approaching it is. While auto insurance has had almost 100 years of refining on figuring out what do customers really want, what are the things they really care about, what are the things we should protect ourselves from. While this is so new that they're still all figuring it out.
So initially, car insurances were also different?
Yeah. Every company will try to have a competitive edge by offering something a little bit different. But eventually it'll normalize and distill down to the core things that everyone cares about.
Another question?
Sure.
When you said that if you put on your if you give answers to the initial questions, you might get audited on your
Yes.
recovery plan or pen test. Those pen tests also certified, or are there?
So generally what will happen is the insurance company will have a list of approved vendors that they will trust a pen test from. So if you've already gotten a pen test from them, that's fine. Now, of course, there's some companies where they'll say, well, any pen test is fine, and they just review the results to make sure they're comfortable with it. Again, it varies. The more mature companies will have a list of approved ones that they will accept a report from.
So in America, there's no such thing as a certified company. Because in the UK, you can have, as a pen testing company, as an IT company, as a security IT company, you can get a stamp approval by the government.
From the government, I don't think we offer anything here in the States that I'm aware of. I think there was another question in the front. Yeah.
So, cyber breach versus the actual time the breach is discovered varies, and insurance policies currently are based on time for, let's say, like the auto industry. How do you compensate for the time differences of when the breach is actually discovered versus when it actually happens?
As long as you're paying your premium. So let's say I got breached yesterday. I buy a policy tomorrow. If there's evidence that the breach happened before the policy went into place, then it doesn't count. Just like if you crash your car and then buy insurance, you're like, well, no, I crashed my car during the policy, and they figure out that it wasn't. Similar situation.
So basically, the point at which the breach begins is the point, as long as it overlaps within the policy's coverage, you're good. Otherwise,
Yeah.
if they find out about it, let's say you stop paying your premiums or you stop going with the insurance company.
Correct. Yep.
They would still cover it.
I believe so. Yeah. Yeah. Question? I play one on the internet. No, I just play one on the internet. Any other questions? Yes?
Can you offer any more information about claims and payouts? In other insurance companies, the companies have become very sophisticated at not being responsible in claims file and not actually paying out what they
Yeah. So insurance company. Yeah. So the reason why those questionnaires are so vague is to allow them to be able to do that. Now, I have heard anecdotally, you did not hear from me, but there are even instances where insurance companies are paying even though they don't have to. The reason they're doing that is to be almost a good gesture to the market to demonstrate, hey, this is a real product. You will actually get claims paid if you have a breach. So it's a game. It really is a game. In any new type of market, it's a game. Yeah, question?
Question with reference to that claims. Right now, I think you said that insurance companies are being rather liberal in terms of claims payout. But in looking ahead, insurers are going to say, you know what, our customers went through these check boxes. like an audit, and we're going to vet them a little more closely, and now we're not going to pay. And you mentioned there was an incident as of late where insurance companies were suing their insurer, I guess, for, is it negligence or falsifying or misrepresenting their...
It's misrepresentation. I think the specific case was the question they answered yes to was they answered yes, we do continuous monitoring of the network, we refresh this every so often, and then it came that the reason why they got breached was because they were not monitoring their network traffic and something bad was happening, they didn't know, and it just started spiraling out of control. I think that was the case. So it was probably misrepresentation, but again, you have to remember that the people who are answering these applications are not security people, they're risk management or finance folks. So that's why it's very important that if your company is interested in engaging in this type of policy and application, they need to involve the people who actually understand the topic. Because the chief risk officer may go to the CISO and say, hey, yeah, do we kind of do this? And they may, yeah, we do X, Y, and Z in technical detail. And the risk management guy may not understand and say, oh, yeah, it sounds like, yeah, we do all of that, and answer that way in the application.
Also, there was an incident just recently I read as well where an insurance company, there was a breach in the Midwest. It was a bank. The insurance company paid the bank for the breach. In moving forward, the insurance company brought lawsuit against, I guess, their web development company for subjugation, I guess.
Yeah, that goes back to liability litigation. I mean,
so now they're looking at your partners, meaning the insurance companies, are saying, okay, your company was hosted or they developed an app or a website or something like that that was not secure, and we're suing them to obviously recoup their costs for your breach.
Yeah, I mean, absolutely. I could definitely see that happening. And in a way, it's the insurance company's fault too, because they didn't understand the complexities of their customer's environment. I mean, one thought right now, I think there is a new cyber bill that is going through, has to do with supply chain, understanding supply chain of technology inside of company. And if this gets passed, any company that does business with the government has to be able to provide a bill of materials for all of the software that they build. You know, what open source, does your software leverage any open source components? If so, what version numbers? If this version, are there any known vulnerabilities at the time of when this was being done? Are there known vulnerabilities? So being able to provide a bill of sale and that transparency also helps understand that risk. Right now, companies don't do that. So this cyber bill that they're trying to push through will require that for companies that do business with the government, but there's nothing to stop insurance companies from adopting that same methodology and understanding the bill of materials that goes into their customer's environment.
Away from that, aren't we?
Yeah, we are a long way from that, yes. Yeah, it is a wild, wild west. Any other questions? Great, well, thank you very much. And if anyone is interested in the scotch, come see me. I can share some. I turned it off, sorry.
There's a little bit of a break before the next talk, which starts right at 2. If you're doing HeboCon, the robot battle, you need to finish your robot by 2 p.m. over in the pool area. If you have not made a robot and you want to make a last-minute robot like everybody else, Trent from Mag Labs, who's running the contest, is headed back from the 99-cent store with a whole bag of treats, which you can build a samurai robot with. So if you're interested in that, go out to the pool area. Otherwise, wait here for the next talk. Thank you.